Welcome to Part 4 of Auditing Standard number 5. In this section, we cover using a top-down approach. AS5 has over 100 pages, which is really heavy, sleep-inducing type of reading. So I'm going to make it easy to understand. It's our Cliff Notes version. This training gives context to SOX 404 requirements. It's meant to be an easy to understand breakdown of dense words, and because the literature, there's so many parts to the literature, I have broken it down to smaller parts, part 1, part 2, and you can see here based on your focus or the areas you're interested in, you can then listen to selected parts. And it's meant for people who need a refresher, or if it's your first time exposure to SOX 404, you can then get an overview. This table of contents came directly out of Auditing Standard 5 from the PCAOB. I've just made it into chunks so that it's easier to understand and follow. Using a top-down approach. So this is the phrase that you will often hear in the industry now, a top-down approach. The history of it, I mentioned earlier, is because in AS2, it was just one size fits all. And in AS5, they've changed it to say, here's what the top-down approach is. And you will notice, this is also top-down approach. This one section is only paragraph 21. And it's so packed full, and I'm going to focus a lot and spend a lot of time on this. So the auditor uses a top-down approach, and now the PCAOB kind of says, here's the thought process of how we're going to define a top-down approach. It says you start with the financial statement level. So look at your balance sheet, look at your P&L, look at your statements of cash flow at that level, and with our understanding. Then you drop down to the next level of, and the financial statement level of where we're focused on internal controls, that means that you don't have to look at every single GL account. Financial statement level is different than GL level. The difference is a GL or a trial balance. If you go through, let's say, a cash balance on the financial statement level, let's pretend it's $1 million. That $1 million could be made up of one bank account that is in the GL, or it could be made of 100 GL accounts that aggregate to the $1 million. And in this top-down approach, it says, look at cash as a whole, the total the total financial statement level. Okay. The next part then it says, focus on entity level controls, because the tone at the top, going back to Enron, it started at the very top. It was people who had the tone at the top of how do we cheat, how do we put pressure to meet our financial incentives. So that's why there's so much focus now on entity level controls. And the reason why you see the word entity level controls versus company level controls, early on in AS2, some people use the word company level controls. Entity is broader than company. You can have 10 companies, but they all roll up into an entity. What is that overall organization? What's their tone? How do they conduct themselves? How do they have the moral compass? It starts at the very top with the CEO, with the CFO, with senior management. Next, it says works down to significant accounts and disclosures. So, as I mentioned earlier, when you start with the financial statement level, now look down to the significant accounts. So in my example of cash, of your 100 accounts of cash, of your GL accounts of cash, you may have 2 cash accounts that are the biggest dollar amount. It's the 900,000 of your million. Well, you'd want to focus on the 2 or 3 significant accounts. Or there may be an account that's risky of some sort, but it doesn't mean because you have all of these accounts that because you have 100 GL accounts or bank accounts, not all of them are the same. It places emphasis on significant accounts. It also includes disclosures. So as you notice, the balance sheet, the P&L, the cash flow, but then in the financial statement disclosures themselves, there are often disclosures around debt. There's required disclosure around stock options. The disclosures and the information to accurately disclose the information is also included in this scoping, and then the relevant assertions. Now, what are relevant assertions? The assertions are completeness, accuracy, presentation. Those are the types of things. So let's say your cash account, existence. Cash account, assets tend to be around, does it exist, right? We always want to include, it's less about completeness, because if it's an asset, the incentive is to add all the assets on your balance sheet and make sure you get credit for it. The flip side on the liabilities, well, completeness is actually the higher risk. The assertion around completeness is more of a focus because it's a liability, either you're not aware of it because someone hasn't told you, or you have more incentive to leave out your liabilities and show higher equity. That's why you focus on the relevant assertions. Is assets, you're focused on existence and accuracy of the amounts. On the liabilities, you focus on the completeness of it. Maybe it's the disclosures and classification. Because if you have a certain covenants, financial statement covenants for your debt or lenders, and you have an incentive to move something from current liability to long-term liability, the classification, the presentation of it, and the completeness of liabilities, that's what they talk about when they talk about relevant assertions. And then again, this is focused around financial statements and related controls. So when we do the scoping, we talk about, we don't talk about operational types of risks, because when we go through a SOX audit, we hit so many areas within a company. This helps us narrow the scope to say, does it impact the financial statements and the disclosures? If it doesn't, then it's out. We scope it out. Next part of it is the risks in their processes, right? So now you have significant accounts, disclosures, and the assertions. Then we look at the processes. So in the case of cash or AR, that's generally, AR is around the order to cash process. Cash also overlaps with the procure to pay process. And we then select the controls that address the risk for each of the assertions. So now we start out financial statement, we work down to the significant accounts and disclosures, then we work down to the identifying the processes, and then within those processes, selecting the controls that mitigate the relevant assertions. That's the top-down approach. And you see this note at the bottom here. This comes directly out of AS5. I didn't make this up. The top-down approach describes the auditor's sequential thought process in identifying risk and controls to test. This is the thought process you think about. It's not the sequence of performing the audit procedures. Although it's the thought process, oftentimes it leads to a bit of the sequencing. The sequencing will generally follow this thought process, because in order for you to, you have to look at the financial statements, then we usually look at entity level controls and try to see how that impacts the rest of it. Now you know about the top-down approach and the thought behind it.